Hey, I'm Tom Crosshill. I'm a professional investor with 17 years of experience, and in this video, I will answer investing questions from the internet. Wild Pokemon asks, I'm 27 and looking for ways to get independent from my salary in 10 to 15 years while having a good lifestyle. Any advice? Well, my first piece of advice is to buy some Nvidia stock 10 years ago. Now, if that's impossible, then you will need to save 50 to 70% of your income and invest it in the market if you want to reach financial independence that quickly, okay? Realistically, most people in Europe will not be able to reach full financial independence in just 10 to 15 years. But the good news is there's a better alternative. Retiring early is overrated. You get bored pretty quickly. I know because I've tried it myself. Instead of that, most people would prefer semi-retirement. That's where you have enough capital, enough passive income to cover a lot of your needs. So you can work less or do just the kind of work that you love and enjoy life in the meantime. Baby Lola 266 asks, so how do you start investing? All you need to do is open a brokerage account. And don't overthink it. For your first investment, almost any licensed brokerage will do. You can go with the Giro or Trading 212 or Trade Republic or Lightyear or any other reputable brokerage. Put in a bit of money, maybe 50 or 100 euros, and just buy a stock or ETF that you have heard about. Just get going, become an investor. And then you can start down the road of educating yourself about different investments and investment strategies and all the rest. Should I actively manage my portfolio or invest passively and keep working? Well, let me just ask you, do you like wasting your time? Because there is very, very little probability that by actively managing your portfolio, you will add value. In fact, most research out there shows that the more actively you manage your portfolio, the worse your expected result. You are much better off keeping your day job and making more money that you can then save and invest. Investing in equities with markets at all-time highs. I know I can't time the market, but it feels wrong. I know exactly what you mean. For years and years and years, I've had this feeling. The market is at all-time highs and I'm putting in money. It just feels wrong. How is it possible that for years and years and years, the market has been at all-time highs? Well, it's because the market is supposed to be at all-time highs on a regular basis. In a typical year, the stock market hits all-time highs between 15 and 20 times. We invest in the stock market because we expect it to go up. Companies make money, they expand, they innovate, and the market goes up. Now, of course, there are some years when the market drops. The problem is nobody can predict exactly when. So that's why most investment experts just recommend not worrying about all-time highs and investing your money on a regular basis. I have $10,000 for a down payment on a house I can't buy just yet. Where should I put it? Probably not Bitcoin. Long-term investments like the stock market or potentially profitable gambles like Bitcoin can be attractive if you want to multiply your money, but they're not so good if you want to protect your money, to keep it stable, okay? So for that, you might want to look at a high yield savings account in your bank, or if that's not available, you can look at money market funds. In Europe, you can easily buy money market ETFs. So these are funds which invest in very short-term, very high-quality bonds. So that means your money is well protected and you make a profit of a few percent per year. Someone from Reddit asks, will there be taxes on my stock investing profit? Yes, there will, but if you're smart about it, you can often pay less. Many countries in Europe have special tax exemptions or incentives for long-term investors. For example, in the UK, you can use ISA accounts to invest a lot of money every year tax-free. Or in the Czech Republic, if you hold stocks for at least 3 years, you can usually sell them without paying any tax. So before you start investing, make sure you investigate the tax benefits and exemptions available in your country for investors. Reddit user JSJCJJX asks, I want to cash out all of my investments and retire in a low cost of living country. Bad idea or brilliant? Moving to a low cost of living country can be a great idea if you want to retire early. It can definitely help your money stretch much, much further. That said, sometimes you get what you pay for. 10 years ago, after leaving Wall Street, I decided to spend a year in Cuba. And I quickly discovered that if you are willing to live like a local, which means living in a rundown apartment, eating very basic food, struggling to get necessities like soap or toilet paper, well, then life is very, very cheap. But if you want to live like a Westerner with a comfortable apartment and nice food and all kinds of services, then you can easily spend more living in Cuba than living in most European countries. Now, the other part of this question is if you should cash out all your investments to retire early. And there, the answer is almost always no. You're going to be retired for many years, so it's kind of silly to keep your money in your bank account where inflation makes it lose value. Sapiens Cool asks, FOMO, should I buy individual stocks like Nvidia or Magnificent 7 stocks? If everyone's talking about some hot investment, chances are the price is already quite high. Now, you could get lucky and jump in and benefit even more, but in many cases, FOMO is just the recipe for buying stocks at expensive prices. Someone from the EU personal finance subreddit asks, are investment funds offered by insurance companies worth it? The worst investments I have seen in Europe have been investment funds offered by insurance companies. Now, insurance is a great thing and investing is a great thing, but combining them is like putting ice cream on hot pizza. It just doesn't work. They will create this zombie package, which has life insurance worth, let's say, €5 or something ridiculous like that, and then an investment fund which charges you 3 or 4 or even 5% per year in fees. It is absurd. And the reason I get so upset about this is because here in Europe, these products get sold to couples who want to invest for their children. They get sold to older people who don't know any better. And it just pisses me off. So if you are looking at one of these products, make sure to ask for the key information document. It's the only place where you can get reliable information about the total costs that you will be paying on your investments. IGX asks, best strategy, all in or averaging? That's very cryptic, but I think what IGX is asking is, if you have a whole bunch of money to invest, should you put everything in the market at once, or should you dole it out over time and invest it in, for example, 4 parts over the course of 4 months? Well, to this question, there is the correct answer and there is the realistic answer. The correct answer statistically is that you should invest everything at once, because most of the time that will give you the best result. The market on average goes up, so the earlier you put your money to work, the more you can expect to make. Psychologically, it's difficult because there's a risk that tomorrow the market could drop and you could lose a significant part of your savings. That's why realistically, the answer that I usually give is it's fine to start with a small amount. Just invest whatever you are comfortable with. Get started. And once you feel more confident, you can invest the rest. Te Augusts asks, where do I find information about companies so I can decide if they are worth investing in or not? Well, here's the best strategy, okay? You need to hire a monkey, blindfold him, give him a list of stocks and some darts, and have the monkey throw the darts at the list of stocks. Whatever stocks the monkey hits, those are the ones you want to buy. Picking stocks at random is just as likely to get you a good result as either paying a professional to do it for you or trying to do stock picking on your own. Just to give you an idea, a piece of research from Arizona State University said that over the past 90 years, there have been 26,000 different stocks available in the US stock market, and half of all the profits for investors came from just 83 stocks. That's 83 out of 26,000. So here's the advice I give to most amateur investors. Go pro or go passive. You either study hard and get your CFA certification and become a professional stock investor, or you just buy some ETFs or index funds. You're likely to get a better result that way. Steve1521 asks, why does Warren Buffett promote a passive ETF investing strategy while he basically built his great fortune being a very active investor, stock picker? Isn't this a contradiction? Well, I think he's actually afraid that you might steal his profits. Seriously though, Warren Buffett is a highly successful investor, and he's also a good example of what it takes. He has spent all his life studying the stock market, studying ways to pick stocks, working at it like many hours per week. Now, I can't speak for Warren Buffett, but I assume that he recommends index funds and ETFs because he realizes that for most people, becoming a professional investor like him is not going to be possible. Joe Drunk asks, why does it seem like S&P 500 index funds are always recommended? Why not NASDAQ or Dow Jones? While the S&P 500 is a celebrity among stock indexes, the NASDAQ also has many index funds and ETFs tracking it. The famous Dow Jones Industrial Average, though, is kind of a crap index. It's what's called a price-weighted index. Most popular market indexes are weighted by market capitalization. This means that bigger companies have a bigger impact on the index level than small companies. The Dow Jones Industrial Average is price weighted, so companies with higher stock prices have a bigger impact. The problem is that stock prices are kind of arbitrary. They are not really tied to the importance or size of a company. And because of that, the Dow Jones Industrial Average is not very useful, and it's also kind of hard to build an index fund or ETF that tracks it even if you wanted to. Komesi Posta from the EU Personal Finance subreddit asks, should I invest my money at such an early age as 13? Well, it's awesome that you're thinking about it. I've got many investing students who only start thinking about investing at 50 or 55, and they still manage to be successful, but it's much harder. So the earlier you start, the better. In most cases, for 13-year-olds, I would say enjoy life and also put your main focus on improving your skills so that when you start working, your income is higher. But if you do already have an income or significant savings, then by all means, learn to invest and start doing it. YouTube commenter Keita asks, hey Tom, I absolutely love your content and would love your help. I am 21 years old and would like to invest in ETFs, but how many should I be buying? That's actually a common misconception. People think you need many ETFs to diversify your investment, to split the risk. In reality, a single ETF usually already invests in hundreds or even thousands of different stocks. I personally have most of my portfolio in just one ETF. Now, if you have a more complicated strategy that involves investing in different sectors or different regions, or perhaps you are older and you would like a mix of stock ETFs and bond ETFs, then of course you will have more than one ETF in your portfolio. But for many investors, just one or two ETFs can be more than enough. Instagram user Ryan Uploads asks, how to navigate tax and regulation rules as an American living in Europe? Well, you're screwed. Sorry to say that, but life for Americans living in Europe is not that easy when it comes to finances. Many banks and brokerages want nothing to do with you because of heavy regulation by the US government. And then if you do manage to open an account, the set of investments available to you is quite restricted. The big popular American funds like SPY and QQQ are simply not available in most European countries because of EU regulations. Now, there are lots of European funds that we here in Europe can use to invest in the S&P 500 or in global stock indexes. But the problem is, if you as an American buy those, the US government has some really annoying tax laws. You will have to fill out some horribly complicated forms every year to report these investments, and you will have to pay a lot of taxes, a lot more than is reasonable. That means that Americans living in most European countries can't really invest in index funds or ETFs. But you can invest in the stock market as long as you can find a brokerage with low fees and build a portfolio of many different stocks.